Hey, welcome to The Explainer. Today, we're going to pull back the curtain on one of the most successful investment philosophies ever. We're going to learn how to think like Warren Buffett, not as a gambler playing the stock market, but as a real, honest-to-goodness business owner. All right, let's dive right in. And we're kicking things off with the classic Buffett zinger. Right off the bat, this quote just completely challenges what most people think an investor is. Buffett wants us to throw out the idea of constant trading and think about something much, much deeper. So what's he really getting at here?
Our first stop, what you could call the Wall Street casino. We're going to look at how Buffett's whole approach is pretty much the polar opposite of the complicated and, let's be honest, often baffling theories that get taught in a lot of finance classes.
So you can really see the two camps here, right? On one side, you've got modern finance theory. It basically says the market is always perfectly rational, so trying to pick stocks is a fool's game. On the other side, you've got intelligent investing, the philosophy Buffett learned from his mentor, Ben Graham. It says the market is often driven by emotion, by fear and greed, and that right there is why digging deep into the business itself is absolutely essential. It's a total clash between abstract math and on-the-ground business reality.
Okay, so let's talk about this thing called beta. In academic finance, it's how they measure risk. Risk equals volatility. Buffett, though, he thinks this idea is, well, kind of ridiculous. I mean, think about it. According to beta, if a fantastic company's stock price gets cut in half, the stock is now suddenly riskier than it was at the higher price. Does that make any sense? For an actual business owner, getting a chance to buy more of a great company for cheaper, that's not risk, that's a golden opportunity.
And this quote just nails the problem with ideas like beta. What Buffett's saying is, trying to be super precise with a formula that's fundamentally broken, that's just a recipe for disaster. It's way, way better to be about right when it comes to the real messy world of a business than to be exactly wrong using some fancy but flawed math.
So, if the market is irrational, how are you supposed to act? Well, that leads us to probably the single best metaphor in all of investing, a little character Ben Graham invented named Mr. Market. Seriously, if you can get your head around this guy, you've basically mastered the emotional side of investing.
So picture this. You own a piece of a business, and you have a partner, Mr. Market. The only problem is he's, let's just say, not the most stable partner. As Buffett says, he's got incurable emotional problems. Some days he shows up just giddy with excitement, offering to buy your shares for way more than they're worth. Then other days, he's a total basket case, convinced the world is ending, and will offer to sell you his shares for pennies on the dollar.
Okay, so here's the absolute key to this whole thing. You are in charge. He names the price every single day, but you don't have to do anything. You can just tell him, no thanks today, pal, and go about your business. The secret is to use his wild moods to your advantage. When he's miserable and offering you a bargain, you buy. When he's euphoric and offering you a crazy high price, maybe you sell. The bottom line is, you stop seeing market swings as a threat, and you start seeing them as your single biggest advantage.
And this perfectly sums it up with another classic line from Ben Graham. In the short term, stocks go up and down based on popularity. It's a voting machine. But over the long haul, a business's real, fundamental value, its earnings, its assets, its actual weight, that's what ultimately wins out.
Okay, so we've got the mindset down. Now for the nuts and bolts, the golden rules. How do you actually put this into practice? How do you find those great businesses and turn Mr. Market into your own personal ATM?
So the story goes that Ben Graham was once asked to boil down the entire secret of sound investing into just 3 little words. Any guesses? What do you think they were?
Margin of safety. That's it. This, right here, is the absolute bedrock of the whole philosophy. It just means you only buy a business when its price tag is way, way below what you calculate its real value to be. That gap, that cushion between the price you pay and the value you get, that's your protection. It's your buffer against being wrong, against bad luck, against all of Mr. Market's craziness.
So with that margin of safety as our foundation, a few other golden rules naturally follow. First, stay within your circle of competence. Simple rule. If you can't explain the business to a 10-year-old, you shouldn't own it. Next, always remember you're buying a business, not just a little green or red ticker that wiggles on a screen. You also need to look for businesses with what Buffett famously calls an economic moat, a durable competitive advantage that keeps competitors at bay. Of course, you have to demand honest and capable managers. You're basically going into business with them. And finally, just stick to the easy stuff. You're looking for 1-foot bars you can step over, not 7-foot hurdles you have to be a superhero to clear.
Oh, I love this quote. It's just such a smart, witty way of saying it's so much more important to be in a good business than it is to be a genius manager in a bad one. Like Buffett says, when a manager with a reputation for brilliance takes on a business with a reputation for being terrible, it's the reputation of the business that's going to win that fight every time.
All right, so you follow all these rules, but you still need one last absolutely critical ingredient. It's the ultimate edge any investor can have. And it's not some secret formula or an inside tip, it's patience.
This is such a powerful way to think about it, isn't it? All that frantic activity, that jumping in and out of stocks, flitting from flower to flower, as Buffett calls it. Who does that really make rich? Usually, it's the brokers. Real wealth, the kind that lasts, is built by the person who finds a wonderful business and just sits tight, letting that business do all the heavy lifting for them over years or even decades.
And if you want to see what that looks like in the real world, just look at this number. $2.1 million. So what is that? Where does that number come from? That's what a single $40 share of Coca-Cola bought way back in 1919 was worth by the end of 1993, assuming you just reinvested the dividends. And that didn't happen because of some crazy trading strategy. It happened by owning one great business and patiently letting the magic of compounding do its thing.
Which brings us to this little piece of advice from Mark Twain, which Buffett absolutely loves. And it completely flips the usual advice on its head, right? Instead of so-called diversification, where you spread your money thinly across 100 things you barely know, the idea is to put your eggs in a few baskets that you really understand, and then, as Twain said, watch that basket like a hawk.
So, I'll leave you with this final thought to chew on. Are you letting the manic moods of Mr. Market push you around? Are you just playing his game, reacting to every little twitch? Or are you making the market play your game? Are you a gambler or are you an owner? Because figuring out that difference, well, that's everything. Thanks for joining us on The Explainer.